The stores that already exist are declining in revenue consistently. And you want to hope and pray that bad news comes out. This stock will never ever see below 100. Did they care?
No.
We could not care less. Lowe's reported just the other day, they reported $2.28 in earnings per share versus expectations of $2.21. So they beat on EPS. However, they missed on revenue, $22.45 billion in revenue versus expectations of $22.69, and worse yet, a decrease of 1.5% in same-store sales. Guys, if you've watched our channel before, the one thing I talk about with retail is same-store sales. In the 10K, it'll be comparable store sales. The reason being, any retail company can grow just by putting out more and more stores. But if the stores that already exist are declining in revenue consistently, there is an issue. Now, this is a quarterly result. Does that mean that you should avoid the stock? Well, the stock's already down 5% almost today after this happened. So the stock is down, but remember, on this channel, Mo and I are long-term value investors. We could not care less what is reported quarter to quarter. I repeat, we could not care less. What we care about is, are there fundamental changes in the business? Go look at any company you love. Apple, Microsoft, whatever company you love. They don't beat all the time. They shouldn't beat all the time. If they do, they're either manipulating the numbers or they're hedging and they're telling Wall Street, lower numbers just so they can beat all the time. What we care about is buying a good long-term business. Look at Berkshire Hathaway, Mo. Their operating earnings were down 8% last year versus did they care?
No.
Because their job is to build a good quality business. Right? Yeah. And what do you care about if analysts project X, Y, and Z and they miss by 1 penny?
Right.
Is that really they missed by 6 cents here. It's less than 3%.
Right.
The company's down 5%.
Warranted.
That's sarcasm.
Yes.
So Mo, what's the other reason they're down so much?
So the outlook. The outlook is the big thing, I think, and why you're seeing that reaction. Total sales, they are expecting $88 to $90 billion. That's what Lowe's expects. Analysts wanted $90.5 billion, so that is a miss for them. That's, I think, why we're seeing a lot
for
of
this upcoming year, correct?
For the upcoming year. For 2023, also comparable store sales, flat or down 2%. Obviously, people don't like that. They were down 1.5% this year compared to last year. So there's a couple of things in here, and I personally think this has a lot to do with forward guidance and outlook, and I see you're pulling up Home Depot and seeing what they're saying. From what I'm seeing, not that they're exact numbers, but Lowe's, Home Depot, Walmart, and Target, they're kind of all in that same situation where they're pulling back on total sales expectations or trying to figure out where sales are going to come from because they're not coming from non-discretionary items, discretionary items. And same store sales, everybody is saying that they're basically going to be flat or down or slightly positive.
Home Depot's just saying the same thing. And by the way, Home Depot beat on earnings, but missed on revenue.
Yeah.
Same as Lowe's.
Target yesterday said their revenue was going to be in line, but their same store sales was going to be either down or slightly positive.
Man.
So Walmart's probably saying the same thing. I just can't remember off the top of my head. But those are your big four retailers, big box retailers.
Yeah, and guys, again, your job is to find good quality businesses at good prices. You want to take advantage of bad short-term news. Every company in this world is going to have bad short-term news at some point. Look at Google. Google was a stock. You go look at our past videos of Google when it was at $150 a share. People were literally like, this stock will never ever see below 100.
I think
it's been nothing but below 100 for the last 6, 10, I don't know.
Low is like 83 and change.
Correct.
People were like, there's no chance that's going to happen.
And there will be a time when Google's selling for a price because people say Google is dead.
Yeah.
You find these opportunities, but you have to look in the numbers and understand what are these numbers doing. So in our community, these are the things that we do in our community. We sit there and we talk about these companies from a long-term perspective. Mo, would you be surprised if Lowe's was out of business in the next 10 years?
Yes.
I would too.
I'd be shocked.
I'd be absolutely floored.
I'd be shocked.
Your job is to determine a value for Lowe's. Use a stock analyzer tool, which we're going to get to. Use your assumptions for the future and determine a value for Lowe's that you want to buy the company at. And you want to hope and pray that bad news comes out, that drives that price down because people's short-term reactions are bad. So if that appeals to you, this software can help you do that. We have a special running right now, $7 for 7 days on everythingmoney.com. Sign up. Guys, it's just $1 a day to try it out. I guarantee you it'll change the way in which you look at investing. Our stock analyzer tool, which you'll see shortly, was used over 1.3 million times last year. It gives you a price that you want to pay based on your assumptions. So let's take a look at the 8 pillars on Lowe's. All right. So a little bit more in debt, which doesn't bother me, Mo.
No.
This debt doesn't bother me at all.
Especially because capital lease obligations.
Yeah, I mean, it's a retail location. They have to have it.
Yep.
And so look at this. The PE is actually higher than the price of free cash flow, which I like a lot.
Mm-hmm.
Okay. Now, is this a reasonable PE and price of free cash flow? I don't know. But Mo, what the hell is that?
I know. It's amazing. That is an amazing ROIC. And actually, if you look at the 1 year, 93.44%.
So guys, what's the ROIC? It's the return on invested capital. This means the company does a good job of investing the money that's in the business. The higher the ROIC, the less the company needs to invest back into the business to generate more and more earnings. So if they have to invest less money than, let's say, a company that has a 10% ROIC, they have to invest almost 5 times more money, 4.8 times more money to get the same growth in earnings that Lowe's does. Would you rather pay more for a business that has to invest less to grow earnings or more to grow earnings? Of course, the one that has to invest less. That's why we want high return on invested capital businesses. Lowe's can grow their earnings by investing less and less money. That leaves Lowe's more money to buy back shares, pay dividends, and give more back to its investors.
Yeah.
And that's the big key. But other things here, revenue growth. I'm going to pull up the 10K, Mo, while you go through some more of your stuff, because I want to see how their growth in locations has gone.
That's a good idea. So the only thing that I looked at, because this was in the business of where people were staying at home and people were just flushing the market, doing things at their house. They had a ton of extra cash and they were stuck at home. What are you going to do? Renovate your house. I was looking at this going back 10 years. I mean, between these 2 years, $3 billion, $3 billion. These are growth levels, $6 billion, $3 billion, and so on and so forth. And then all of a sudden you hit 2020 and you're at 72 billion, and I'm fine with that past 7 years or whatever. You jump from 72 to basically 90 billion, 96 billion, 98 billion. Is that a sustainable level that we're going to sit at? I would venture to say no, and I think we're starting to see that as things are pulling back. Let's look at the net income. Kind of similar situation. You're starting to see that net income come down a little bit, maybe go back to this $3-4 billion range instead of being at 8.5, 5.5 billion. So these are just different things that when I start going through Stock Analyzer, I'm going to say to myself, okay, the revenue growth will probably be there looking out 10, 15 years on Lowe's. It's a great store. People go there. They're working on their pros. They gain 10% in their pro shopper level. This is your professionals that come and do work at your house. But looking out 10 years, maybe they're going to see a slowing in revenue before they see that growth again. So what are you looking for over there?
So unfortunately, they don't have the 10K for 2020. The SEC has not uploaded the 10K yet.
Right.
Let's see what this 8K does. Nothing.
Another thing I don't love about this, but we see it in a lot of these big businesses, they buy back shares regardless of price. They don't care what the stock price is. They're buying back shares every single year. I'm not a big fan of companies buying back expensive shares. I'd rather buy them back cheap. I don't think Lowe's has been cheap in a while, but
absurdly cheap. Like, to me, I look at it going,
like, you have nothing else to do with your cash.
Yeah, and what's their dividend?
It's a pretty good dividend. They pay about a quarter of their free cash flow.
And it's 2%.
Maybe a third of their 5-year.
Okay.
Yeah.
So overall, I look at this going, this is a staple of the U.S. economy.
And home improvement.
Yeah, I actually like Lowe's more than Home Depot because I get more help at Lowe's versus Home Depot. Mm-hmm. So, analysts, did you go through analyst estimates yet?
No, not yet. So let's look through these.
So looking at these analysts, here's the interesting part, Mo. And this is where ROIC comes into play. Look at this EPS growth for the next 5, 10, 6, 7 years, whatever, right? Yep. Look at the revenue growth.
Not keeping up.
So very, very low revenue growth. However, the EPS growth is very high. That's what you get with a high ROIC business. It doesn't take a lot of capital to really drive that earnings per share. And this is something that all value investors focus on. It's something I really want you guys to understand. High ROIC is basically a high quality business, right? Joel Greenblatt talks about it in the little book that beats the market. You want high quality businesses with a moat. This is moat-ish, right? Yeah. I mean, obviously there's Home Depot out there, but
they're one of the 2 dominant players in the space.
Correct. Ace Hardware, is that the other one?
Yeah, I don't think people are going to go there, or Menards.
Save big money at Menards. Yet I'm the one singing their song. All right, so stock analyzer tool. Mo, are you going to do 10-year analysis?
Yeah, I'll do a 10-year analysis here.
Now, guys, I'm going to do 20-year. Mo's going to do 10-year. And this is why this thing is used so much. The future is unknown, but every investment is the present value of all future cash flow. So our goal is to estimate that cash flow, and this does not factor in the balance sheet at all. We're just doing revenue growth, profit margin, all the way down the list, making our assumptions, and it tells us based on our desired return what we should pay for the stock. So I'm doing a 20-year, Mo's doing a 10-year. Okay. Oh, their profit margin is much lower than Home Depot. I think Home Depot is like 10%.
Really?
Yeah. Okay, so Mo, what did you do for your revenue growth?
So I did 2, 4, and 6, and I only did 2 because I'm not so sure that they're going to be able to sustain the level of revenue growth that they're at.
Okay. Now, opening more locations, things like that will help drive it. Inflation will drive it.
Right.
I put 3, 5.5, and 8.
Okay.
8's going to be very difficult for 20 years, guys.
Yes, it is.
I mean, actually, I shouldn't, but the whole point of it is I want to put some major extreme in here to show. Profit margin.
I did 5, 6, and 7.
I did 5.5, 6, 6.5.
Okay. And I did 7, 8, and 9 for free cash flow margin.
I did 7.5, 8.5, 9.5.
Okay. I did 16, 17, and 18.
Oh, wow. You went higher.
Well, I went higher because the ROIC is insane. Plus, they're very modish.
Okay.
So I gave it to them.
I did 15, 16.5, 18 for both PE and price of free cash flow.
Okay.
Desired return?
10, 12, and 14.
Same with me. So guys, this was so low that I'm okay getting the market return based on those such low assumptions. That would be I think this company has to do well more because inflation alone is going to be whatever.
Right.
And they open more locations, they go international, et cetera.
Right.
So I hit the analyze button. The stock's currently at 195. My prices are a low of 130, a high of 270, and somewhere in the middle, probably around, yeah. This is because the free cash flow and the earnings are so different. So I would say probably 150. Look, maybe
160.
Yeah, probably 160. So I haven't watched this at 140. I'm going to change that.
Yeah.
What's yours, Mo?
So I have 113 to 158, 172 to 222. Middle, it's probably about that 160 level. So I'm going to actually move that a little bit too.
So I'm moving mine to 170 so I can sell puts on it at lower prices. But guys, this is the art of investing. This is why investing is so hard. But that's why join the community, $7 for 7 days. Thank you very much for your time.